Welcome to Tonic Boom, a specialist capital markets podcast series brought to you by Tonic, the expertise-led consultancy dedicated to giving firms more. Join our host, our resident Tonic ninjas, and industry experts as we drop the mic on the hot market topics across high-profile domains such as margin, post-trade, treasury, risk, digital, legal, sustainability, and more. More expertise, more trust, more achieved. Ready for your dose of tonic?
Welcome everyone to our latest episode of Tonic Boom. I'm Stephen Czarnota, Head of Digital at Tonic, and I'll be your host today. Today we'll be talking about how adoption of DLT is enabling real-time repo liquidity. We've got a few hot topics to discuss today, so we're going to start off with the business opportunity, where we'll touch on some of the drivers for real-time liquidity and the potential to unlock this through collateral mobility. Then we'll set the scene with what the industry has achieved so far in terms of bringing some of the real-world assets on-chain within the repo market. And finally, we'll wrap things up by looking towards the future, how we can reach that goal of cross-market integration and a single liquidity pool. Today, I'm excited to be joined by three esteemed guests who should give us a broad set of perspectives. Joining from London, we've got Anthony Woolley of Ownera and Richard Glen of HQLAX. And finally, from across the Atlantic, we have Dan Phillips of JP Morgan. So that's enough for me for now. Let's hear from our guests for a quick introduction to themselves. Anthony, can I hand over to you to introduce yourself?
Yes, and a pleasure to be on the podcast with you, Stephen. So Anthony Woolley. So I work for Ownera. We're a tech company based out of the UK. What do? We enable our clients to scale their digital finance strategies. Our core product is something we call a software router, or router if you're British. We sell these routers to market participants, and they enable the connection of the market horizontally and the orchestration of digital transactions between those market participants. So they can do cool things such as instantly exchange assets for cash, cash for cash, assets for assets. People in this industry know the jargon, DVP, BVP, etc. But that's at the start of it. They're agnostic to what those transactions are. And then we have applications running on top of those routers that can do everything from orchestrating repo, as we're talking about today, right through to real estate, private markets, public markets, whatever. And those applications are either built by us, and we now have third parties building applications on top of those routers. I'll leave it there for the minute, and we can get into some of the exciting things that happen in the world of repo.
And Richard, yourself?
Perfect. Thank you, Stephen. So my name is Richard Glen. I lead the team of solutions architects here at HQLAX. What is HQLAX? We operate a digital collateral registry, which enables collateral to be moved from where it is today to where it's meant to be. We do that using distributed ledger technology, meaning that we can instantly update collateral records and transfer ownership between counterparties for a variety of different securities finance transactions.
Very good. And Dan?
Hey everyone, thanks for having me, Stephen. My name's Dan Phillips. I work at JP Morgan, and in our markets line of business, we've had a team of about 10 product specialists that have been working on creating new markets products since early 2022. And our mandate is to try to make the next generation of markets products that take advantage of the benefits of blockchains or distributed ledger technologies. To date, we've spent a lot of time on repo, which we're going to talk about today. We've also spent a lot of time on bond issuances and different varieties of FX transactions or swaps.
Thanks, Dan. So now that we've got a flavor of each of our guests' backgrounds, we can get into the discussion for days. So the repo market is a huge portion of the global collateral market and is critical to firms' funding and liquidity. There are several products in the market already focused on providing real-time liquidity through DLT repo. Some of our guests today have brought some of those to the market. So Dan, maybe you're best placed to open up here and some of the others can jump in. But what's your perspective on the business opportunity that is driving real-time repo on DLT?
Of course. So I think that we actually have an interesting origin story for how we got to be looking at intraday repo at JP Morgan. We actually started in 2019, and it was really a business-driven conversation where the problem statement from our payments clients was, particularly banks and broker-dealers, the problem statement was we need intraday liquidity. Like that's sort of the grease that keeps the engines running throughout the day. But in reality, the unsecured, uncommitted lines of credit that much of the industry depends on, they're actually becoming quite punitive. The different regulatory regimes and the different models that require people to set aside capital in the case that one of these credit lines is no longer available has become more and more expensive. So the conversation started with how can we offer a different sort of intraday liquidity product And the second prompt was that if we have a collateralized or a secured offering, that will meaningfully change the regulatory implications. So that led us to the repo market, where they're very much accustomed to doing short-term secured lending. And from there, we had sort of the current specialist and we had the user experience that we were working towards. So then we sort of had to work around the edges to find the sweet spot. And the problem here was the repo market works very, very well for transactions that are measured in days, weeks, and months. But the user experience that we're working towards was somebody that needed to borrow money for hours and minutes. So that's where we got into the technology conversation of what needs to change for the repo market to compress its time frames so that people are used to talking and executing and settling at this very short notice. And that's where the blockchain conversation came in. So we had people that wanted to borrow through a new structure. We had people that were accustomed to securitized lending, and we didn't have a technology that, in our opinion, would be able to support these types of transactions in such short notice. Conceptually, we agree that all of the CSDs could, in theory, uplift themselves to support these shorter trades. But our approach at the time was that if we build it ourselves, that will meaningfully move the industry forward. So we got together with our payments technology team, who had been working on blockchains for, we'll call it 5 years at that point. And what we built was we built a single dealer repo trading platform that uniquely settles on our private permission blockchain. What that would allow is it would allow JP Morgan clients to borrow cash from JP Morgan under a repo agreement, and it allows them to achieve the DVP settlement efficiency that they're accustomed to by tokenizing their fixed income collateral and using our on-chain cash solution that's called a blockchain deposit account. So that's a long-winded way of saying that we believe blockchains are an option to improve the settlement process for transactions such as repo, and they specifically offer a layer of programmability and precision in settlement that we haven't seen yet from the other venues.
Thanks, Dan. I like the way you framed it from the start of the problem statement through to sort of how you've approached the different options and the sort of final solution. Richard, keen to bring you in on this one. Anything else to add from your perspective on the opportunity there?
Yeah, I was going to just add maybe that, the concept of instant delivery isn't new. Obviously, we're approaching Black Friday. We know as consumers that we all have the ability of buying food, gifts, goods, which we expect to then arrive within a precise moment in time. I guess when we apply that to wholesale settlement markets and securities finance, that concept of instant delivery has always been desired, but it's always been difficult to implement. So as Dan has correctly said, the evangelists in the room have always advocated the use of DLT as technology to facilitate the ownership transfer of goods, in this case securities and collateral, with certainty and control. And that's something that we're looking to try and bring into not only repo markets, but also wider securities finance venues in general.
Yeah, Richard, I really love that comparison, and I use it all the time, trying to help people understand, there's this massive gap in our expectations in what we would accept in our consumer or retail experiences versus what still is expected in institutional finance. It's quite possible that you could be, a top-tier JP Morgan client and call to borrow some money through repo, and you have no way of knowing when you're going to get that money. It could come, thinking about US-centric transactions, it could come at 8:31, it could come at 12 noon, it could come at 1:30, it could come at 2:59. And all of those settlement times meet the current obligations. But it's really helpful if you think about somebody that's depending on that cash to maintain the liquidity of their business.
Exactly.
And maybe I would just add is what you're listening to here is two industry leaders in this space, right? JP Morgan has invested a lot early, building what was formerly called the Onyx team, now Connexus, really thought leaders in this space. And likewise, HQLAX with Richard, Guido and the team, really opening the industry's eyes to the potential of collateral mobility. And both these colleagues here, I feel like I talk to every week, are really leading the charge in that space. And what you find is that we know it's now possible with this technology to do these things, to move collateral instantly, to settle cash instantly. Once you do that, the next order problem you face is that these new technologies can have a tendency to create their own silos, right? And you can end up creating the very fragmentation, which is exactly the opposite of what you're trying to eliminate. So if you took the topic of collateral mobility, the last thing you want to do is trap collateral more than it's already trapped, right? And so this is where, working together, and really, I think, all three of our organizations understand this, you need to be able to orchestrate this horizontally across the market. And maybe that's then when Ownera entered the story, and 2.5 years ago now, when we said, well, okay, you want to do an intraday repo, you've got a form of digital cash, form of digital collateral, JP Morgan can do all of this internally within their world. How can we orchestrate that horizontally? How can we orchestrate an exchange for, say, digital cash, tokenized deposits at JP for digital collateral records that are made possible by HQLAX, and where we come in and we aspire to be, one of a better word, almost invisible pipes and plumbing in this story, but enabling this horizontal orchestration of transactions so that we actually reduce fragmentation, don't increase it, and actually start to deliver on this promise of collateral mobility for the industry, right?
Yeah, I think, Anthony, there's a useful analogy maybe for those people who are listening to the podcast in terms of personal computers, gaming consoles, or even ticketing. So specifically when you wanted to then interplay with friends or colleagues, whether it be from a business context or personal context, that when that technology was initially introduced, you could only do console to console or PC to PC, Mac to Mac at the time being. And what it took then is for those firms to come together to develop standard methods of peer-to-peer messaging or protocols, and really to enable that cross-chain handshake. I think as part of the innovation process, that wasn't something which was anticipated at the beginning, but it is something which has then evolved and has been of use. And that, again, from an application perspective for, I guess, the listeners of the podcast, is a really useful analogy to explain exactly what we're trying to do to wholesale financial markets.
Yeah, definitely. I think that's really useful in terms of framing the business opportunity, and we're starting to touch on sort of where we've got to now as well, in terms of it's not just something theoretical. There's already significant volumes of collateral being moved on chain. So yeah, keen to hear a bit more about where we are now in terms of securities and cash being moved on chain, some of the key progress that's been made, and any insights from the initiatives you guys have been working on. So Richard, maybe I'll ask you to open up on this one, given you've been at the heart of some of these initiatives. Can you give me some thoughts on the current state of real-time repo at the moment?
Yeah, absolutely. And I'll try and frame this in as plain as English as possible. So as we've already talked about as part of the introduction, we have the technology. We know that DLT facilitates ownership transfers of both cash and assets on HQLX and on Connexus so that they can be exchanged when desired and with that certainty and control. We also know that we have foundational legal and regulatory basis. So HQLX, for example, was established in Luxembourg as a result of the 2001 law, which enables then HQLX and our trusted third-party Callisto International to offer a custody, legal and operational model using a secure, shared, distributed ledger database. We also know we have commercial appetite. So, HQLX was founded for the market, by the market. We're fundamentally backed by banks to try and solve problems. That being said, I think all of the people in the room here will appreciate the innovator's dilemma. So we've got evangelists that are looking for change. We know that we have control functions that always find it easier to say no rather than yes. But at the same time, we always find that there are practitioners that are not adverse to change, but struggle to implement it. I'm going to quote Machiavelli. Not sure if there's any gamblers out there that wanted to bet against that on the call, but he once said, where the willingness is great, the difficulties cannot be. And I think that's where we then, as pragmatists on the call, have really tried to move ahead and move forward. In terms of where we are today, so we've managed to develop a production interoperable solution, which allows HQLX through the Ownera routers to communicate with Connexus by JP Morgan to facilitate the ownership transfers of collateral versus cash. In terms of opportunity, I think it'll probably be quite useful to put a number out there, see what type of scope and offer that opportunity that we foresee. So in 2023, the BIS actually published a white paper looking at intraday liquidity. And what they said is that on average, 15% of a financial institution's total daily payment value was consumed just for intraday liquidity alone. As a real number for the Eurosystem, the daily average was estimated to be somewhere in the region of $440 billion. So that is the marketplace that we're looking to attack. The concept of intraday repo fundamentally is attractive. It enables firms to invest or raise liquidity exactly when they need it in the format when they want. And I think that's probably important as we progress through the podcast. We're not just talking about central bank or commercial bank money in the format that we know it today, but we're also talking about new digital formats as they evolve within the concept of regulatory scope. In terms of what we do, so we're fundamentally enabling the ownership of assets on our platform instantly at precise moments in time. How do we do that? Well, what we do is we create what's called a digital collateral record that enables us to record the ownership of assets on our platform whilst leaving them in the location of origin. What's important to highlight from a regulatory perspective is that they are records of ownership, they're not tokens. Tokenization tends to be the term that's used to describe what we do. It's not entirely correct when we look at that with our regulatory hats on. But effectively what the difference is that the record of ownership records the ownership of the real asset in its away location. A token would actually represent a store of value and therefore would be able to be minted or burned or mobilized on its own independently.
Richard, I think that last point is actually a really good example of sort of how we've gotten to this state where we've got different experiments and different strategies of how everybody's trying to achieve roughly the same objective, right? We've got some people that have different jurisdictions. We've got some people that have different technology solutions. And ultimately, we're in this stage where everybody wants to be experimenting to try to do these new things. So that's why we've got, 10 different banks that all have their variety of tokenization. And we've got 5, 6, 7, 8 different fintechs that all have theirs. And I think it's sort of an obvious explanation of how we got to this spot, whereas as Anthony was saying, the market is becoming quite fragmented and we're sort of drifting towards something that's not necessarily better than before. But I think that we should be optimistic that we're working in a space where everybody is interested in trying something. And eventually this will resolve itself in two ways. We'll have interoperability solutions like the one that we're talking about today with Ownera, where you're actually able to transact across these different pools of collateral and assets. And also some ideas will just rise to the top, right? There will be, in 10 years, people will realize that this definition of tokenization under this regulatory regime is better, right? And everybody will then sort of gravitate towards that. But right now we're lucky enough to be working in a point where a lot of ideas are being thrown against the wall. And I'm happy that we're trying to take the technological approach to solve it today, as opposed to just waiting to see what fades away.
Yeah, fully agree.
These things are happening so fast right now. I think at Ownera, we somewhat have the privilege, because we're there orchestrating between market participants and doing it across the markets, across asset classes. We talk to institutions, we talk to fintechs. Things are moving really fast, right? In terms of, you don't need to understand all of the detail of the technology always, but fundamentally what's happening, this is a proper digitization of the financial markets, and it's characterized by the ability to be able to orchestrate and settle transactions instantly, to start to collapse the front, middle and back office if you come from traditional finance, and enable these things to happen instantly. Why would you want to do that? Right? Actually, there's two reasons you might want to do it. One is because you want to save money, but that doesn't always get people jumping out of bed so fast in the morning. But I think there's a massive cost play here, institutions reducing cost of infrastructure. But actually, what's really driving this the last 2 years is strong business cases, new clients, new markets that are really driving outcomes. And in various projects that we're involved in, one common theme that we see running through, which is really a killer business case for these digital technologies, is the mobilization of collateral in various forms, whether you're talking about repo at a large scale bank-to-bank institutional level, all the way down through derivatives margining, all the way down into what I call the crazy world of crypto and what they're doing with DeFi. Ultimately, the power of doing something instantly, buying something instantly is so you can leverage it, right? And we see this theme running right across the world right now. And this is being made possible by various technologies, tokenization, digital collateral records. On the cash side, you've got different emergent forms of digital cash. We've got, organizations like JP leading the charge with tokenized deposit accounts with commercial banks, stable coins, which even 2 years ago was very niche and a little bit crypto, now have grown up. Right, there's now large-scale promotion of stable coins supported by things that are going on in the US, the Genius Act, etc., that are starting to now become real cash options for repo-type activity. And we have long-standing initiatives that are starting to move central bank money in a digital way, which gets to a point where you can actually start to move commercial bank money at a central bank instantly. There's a lot going on. It's sometimes really confusing if you're listening to podcasts and you don't live and breathe this every day. But I think what people need to know is that really finance is going through the digital transformation that other industries have gone through that led to the Amazon and Ubers, etc. You could argue that financial services went digital to some extent in the front offices, being able to agree trades very fast. It's now going through that full transformation that enables front to back office to be aligned, work fast, take ownership of stuff instantly, collateralize it instantly. You start to then be able to collateralize the world. So that's a bit of the bigger picture. And then the front of all of that is if you can mobilize an intraday repo market, that really takes the brakes off the whole of this global collateral space.
Yeah, I guess, Anthony, maybe just adding kind of one other question for me on that one. I guess in terms of visibility, we talk about certainty and control, but I guess what's also powerful with the application of, the technologies that we work with is that we're giving the traders the visibility over the outcomes without them having to engage with those traditional middle office or back office processes.
Yeah, it's quite interesting. It's the approach we've taken to this thing is to connect market participants peer-to-peer. We sell these software routers. We're not in the transaction. They connect peer-to-peer between institutions. They choose who to connect to orchestrate these transactions. But when those routers orchestrate transactions, they all have the same view of the world all the time, instantly. So it means you could have a repo buyer and seller negotiate an intraday repo trade on a trading platform, precise settlement and maturity to the minute, right? Or even to the second. And traditionally, they would hit execute. right? And then that trade would fire downstream, never to be seen again. People in the back office worrying about settling it and clearing it, et cetera, et cetera. It starts there with an intraday repo trade that on a trading platform you can negotiate, hit execute, and it might settle an hour later and mature on the off leg 4 or 5 hours later. But the routers know about that all the time. So you can actually start to give the traders real-time views of, is the collateral earmarked, is the cash in the right place, has it settled? Yes. Is it matured? It's matured now. So you start to see what we call almost salmon swimming back upstream. Capital markets veterans are used to a world where it starts in the front office and it goes back to the back office and it never comes back the other way. You're starting to collapse those two things. So you're starting to be able to get real-time statuses on these repo trades coming back up to the desk. At the same time, it's going through operations, risk systems, etc. So it's all becoming much more digital and instant front to back.
I think it's clear from the discussions so far that the capabilities that are out there today have already made a really significant impact on the market. And I think that's probably not the end of the story as we've alluded to so far. So I think we know there's some way to go before we reach that nirvana of a single pool of all of the assets on chain and a fully connected securities finance ecosystem. So for our last topic, it'd be good to talk about the future here. So Anthony, I think, again, we'll go back to you. You're pretty well placed to answer this one, being at the center of the ecosystem. So can you give us a bit of a flavor of your thinking for the future?
Yeah, and I might pick you up on something you said, because it's not just the future. And I think we're living in a world now where you don't wait and then one day you wake up and finance has gone digital. Actually, it started going digital a few years ago and we're on a curve. So it's like anything, right? It's changing every day. And you wake up a year or two later, you go, wow, everything's changed so much. This is not a future thing, right? This is a transition that's happening right now. So we worked together on the intraday repo platform that orchestrates between HQLAX and JP for 2 years. I always joke that the first year was kind of 80% tech, 20% lawyers, and the second year was 20% tech, 80% lawyers, which speaks to actually what it needs to get this stuff in production. It's now transacted billions of dollars of trades. It's in production. Right. And it's starting to be scaled across the street, because when we built that platform, we built it jointly with a vision not to just orchestrate JP tokenized deposit accounts against digital collateral records at HQLAX, but to have a platform where you can extend it across well-known trading platforms, where you can actually choose a repo buyer and seller could be on whatever platform, and they choose which sorts of type of cash, what sorts of collateral at which locations, and you scale it horizontally. So this is happening before your eyes, actually. A lot of people are not really aware of it if they're busy day to day on a desk or whatever. And then suddenly it's here. Well, it's already here and it's happening and it's now scaling up. The next 2 or 3 years are going to be massive in terms of mobilization of collateral, right? If you can start to really mobilize an intraday repo market, first bank to bank, and if you can do it in the context where you're updating beneficial ownership right back at the CSD, right? That starts to change the model of the repo markets, and it feeds down through an ecosystem of collateral, right? Once you can mobilize these billions at an institutional bank level and then you take it back to client, then you start to move towards this real-time liquidity world where it becomes continuous. At the moment, we talk about intraday repo and overnight and term, and we talk about intraday T0, and then things happen through an overnight process. Ultimately, where this is leading is a 24/7, 365 world. It's the one that the crazy world of crypto has kind of been living in for a little while, with things like DeFi, etc., out on the fringes. But the potential of this then becomes real. You then end up in a continuum, a liquidity continuum, where things run 24/7, 365. You'll still have structures like central banks paying overnight interest at a certain time of day when they close, but these things will move around the world and you start to then get that mobilization. So it's wrong to think, this is a podcast about the future. Let's have a little dip into what's happening in the next few years. It's actually already happening and it's moving under your feet. And I think if you come back to us in 2 years' time and do another podcast, you'll see, wow, a lot's happened in that period.
Yeah, I think, Anthony, you pick up on a really important point in terms of that concept of convergence. So a number of the TradFi problems that are out there are being solved through solutions that have been pioneered through DeFi. And whether we talk about accounts, whether we talk about vaults, whether we talk about wallets, ultimately the solution of ownership transfer is still exactly the same, irrespective of the assets. So the fact that, this group is working together to try and solve the problems using new intelligent technology, programmable workflows, etc., I think is the user experience on the front end that will get the true benefit for all the hard work that's been done in the pipes and plumbing in the back end.
And these digital rails, right, they run all the way from the asset and the issuer and the registrar and the TA or CSD up at one end, all the way through the custodial structure, through distribution, right through to the ultimate beneficial owner. When you can establish those rails end to end, and imagine you can click and you're updating or moving collateral out of CSD instantly, that does change the world. And once you have these new digital rails on strong business cases, such as intraday liquidity, those digital rails will then be what we move all the old stuff onto. Then you follow by moving your bonds and your equities and private markets and everything else. So I think it really is, we're seeing at the start something which is much broader, deeper than many people actually realize.
I think I definitely agree with Anthony's framing that it's not necessarily the future, that it's happening now. And I think anecdotally, like reflecting on all of the conversations I've had with institutions over the past 4 years, 2022 and 2023, it was probably early. I would go into these sales calls and I would explain that we have a new intraday liquidity product that is supported by settlement on a blockchain. And all they heard was blockchain and all they saw were red flags. There's too much career risk. It was a technology that they viewed as unproven. And I felt that change at some point in 2024. The conversation started to shift from being 95% about your private keys and is it like Bitcoin and why is it so volatile? All of those sorts of questions, which were clearly just targeted towards the word blockchain as opposed to institutional financial product. 2024 and throughout 2025, it's been the exact inverse, right? So now I'll have 30-minute sales conversation and won't mention the word blockchain because that's not what they're focused on, right? They're focused on how is this valuable to me? Am I going to save money? Am I going to make more money? How hard is it for me to implement? What are my legal ramifications? So the conversation has really pivoted from selling the technology to selling the financial product. And I think that that's a really good sign for all of us. The metrics aren't necessarily there yet, though. I'm hopeful that this will change by the next time we're on the podcast, but we are still talking about doing hundreds of millions of dollars of client-facing intraday repo per day, which, as Richard mentioned, right, the denominator is huge. So we're still just scratching the surface, but I can tell you from the conversations that I've had of people that are going through the onboarding process now that we're going to see a massive acceleration in the usage and adoption here. And I wouldn't be surprised if we're seeing up to like $10 billion of client-facing intraday repo just from JP Morgan by the end of Q1. So agree, it feels early if you just look at the production metrics, but if you reflect on how seriously the participants are taking it and where they are in their adoption journey, it's definitely not the beginning.
Dan said something really important there about timing, right? Because, and many people know this intuitively, any new technology, it comes along, it takes time. People understand the product market fit, and then at some point you get an inflection point. Everybody's trying to work out where the inflection point is when this thing is taking off. And there are always people in the market whose job it is to be a little bit early. And you've got three of them here, right? Fintechs are often early, like Ownera and HQLAX have been involved in this for a number of years. And we're early for us is the right time, right? Because we are the innovators and we're making this stuff happen. From the institutional side, the early people are the industry leaders. JP Morgan has the scale. And I have to say, Dan has the resources and the wherewithal to put significant resource into areas like digital asset early. And we do the groundwork, right, for the industry. Fintechs can't afford to be late because the incumbents will already have done it, right? We're always trying to land our products in that window between too early and too late. What's happened in the last 3 or 4 years, and people have to realize we've been doing this wiring for some time, right? We've been leading the charge. We speak to a lot of the industry and we speak to institutions and they say, oh, well, we're fast followers, right? If your fast followers are not doing this now, you're going to be too late. Use a market phrase. This is like trying to catch a falling knife. It's happening now. If you're thinking about it now, you're too late because things that you find being announced next month are the things that started 2 years ago. So if anything, we've done the hard work, rolled our sleeves up and maybe leading the charge in some of this stuff, but it's now impactful on a market-wide scale. And if you were starting today in this space, you can learn and benefit from what organizations like JP and HQLAX have already done. It's still going to take you a year to 18 months to get this thing into production. And I can tell you there's a lot you'll see going into production between now and then. So I would, for anybody listening to this podcast, I would say this isn't something to me intellectually interesting, that it's for the future. I think if you're not already got a well-developed strategy and agenda here and you've actually got your sleeves rolled up, you probably, as a fast follower, you're a laggard. You're probably getting too late.
Thanks, Anthony. Love the call to action to sort of motivate anyone who's not started looking at this already. I agree with your sentiment around this is here now and it's sort of how it continues to evolve. Thanks, guys. That's been really insightful to hear from a group who are really at the centre of all of these initiatives and showing that these are happening now, and it's exciting to see how it's rapidly evolving. We've covered quite a lot today, starting off with some of the business opportunities there. We know that real-time liquidity is an ever-increasing need for firms, especially with settlement cycles accelerating and the ever-growing desire for firms to optimise their collateral and their capital. We've also heard hands-on experience of what it's been like to implement this in the market today and enable instant transfer of ownership of assets at CSDs and custodians around the clock. And finally, we got a bit of a glimpse into how the market's going to continue to evolve to achieve full digitization of collateral and fully onwardly reuse that collateral in a unified ecosystem. So I'd like to thank all of our guests here today, Dan, Richard and Anthony. It's been a pleasure to hear some unique perspectives on a hot topic. And I'd like to thank all of the listeners for this episode of the Tonic Boom, where we talked about real-time repo liquidity, and look forward to seeing you again on the next episode.
Thanks, Stephen.
Thanks, Stephen. Been a pleasure.
Thank you, Stephen.
You've been listening to Tonic Boom. Don't forget to like and subscribe to stay up to date on the latest developments and industry opinion across capital markets. Visit thetonicconsultancy.com to see more of our expertise-led insights and end-to-end solutions. Tonic. More expertise, more trust, more achieved.